Thank you very much. I think for the last so many years, we've been talking about that we need trillions of dollars of investments into India. And all of us understand typically that you required 70, 80% of debt and 20% of equity. And equity did show up in India. The capital markets are doing well. But if you look at the debt capital market or even the lending money, that virtually was missing. And one of the reasons I always thought about is that if you are an equity holder, you still have a certain rights in India. You can manipulate the system, you can strip the company, you can do all these things. But if you are a lender in this country, you're probably, in the waterfall, you are ahead, but in real fall, you're way behind the curve. And I think that's a big issue. So when we look at IBC, and what has happened in India in last 18 months, not 12 months, but 18 months, because the entire corporate insolvency law was enacted and came into force in end of 2016. And then the RBI came up with the Dirty 12 in middle of 2017. And we are at actually now 2018 middle. And we've resolved 3 important cases. And I think in one of the cases, you've been there. You're part of the monetarist path. So I would say that if you really look at the way we have progressed, like when we look at it, there was nothing there. We made a lot of progress. But if you look at it, why we were not there? And if we were not there, and if we required the trillions of dollars of investment, and if lenders do not have right, if they can't foreclose, will India ever get to the 10% growth? I remember being in Japan 3-4 years back, meeting JBIC, the Japanese investment bank, Japanese export-import bank, and they said, we will never take a project risk in India. We will never take a project risk. We will fund ICICI, who can take project risk, but we will never take. And now in 2018, they are taking project risk. So I think a lot of things have happened. So maybe for you to talk about is the glass half full or still empty?
So, Mohit, I think I'd say half full, half empty. It's a way of looking at things. The way I'd see it is, have we achieved a lot? Yes, we have. If you start at the beginning, right, if you go back 5 years, resolving insolvencies in India was a time-driven, time-taking process of time, and it's something that took a long, long time. At least we had CDR, then we had Sarfazi. We've tried a few things. So I think the new code works. Can it be improved? Of course it can. Everything will need improvement. But I think overall, we've had 3 resolutions in place now. Several small ones have already been resolved. So I think things are working. Case laws coming into play. There is a ecosystem developing. Again, can it be better? Of course. Everything can be better than what it is. So I don't want to keep complaining. But the right thing is we have achieved a lot. If you think about it, resolution professionals did not exist, right? That whole aspect has come through. Law firms have now got practices which are focused on this. So I think all the things are pointing in the right direction. I like it.
Any more comments?
I tend to agree with Parth. I think we've achieved a lot. And if you ask me, the biggest change is, the mindset. Earlier it was unheard of that a promoter would lose his company. Today, people have lost their companies. Management and ownership have changed hands. And I think that's the biggest single behavioral change. And, I was at the SBI conclave 3 weeks ago. And, with the CFO of SBI, the chairman of SBI, eminent bankers were there. That today, that is resulting in a complete rethink in lender behavior. And I think that cultural change is going to increase and, increasingly seep into corporate India. I think that's the biggest achievement, if you see.
But one thing, when I talk to lenders, and yes, they feel the promoters are losing company, somehow we still feel sorry for the promoter. That's a very interesting Indian culture. Really, globally, people will lose company, and that's okay. But I think somehow we feel, actually, if you are a lender and you have not been paid prior to an equity holder, in the waterfall itself, the equity is washed out. So if that is the case, and the value of these assets are negative, that's the reason you're foreclosing, what's the big deal about a promoter losing company? Because, actually, it goes back to my first statement, that promoter, even if the value was eroded for banks, it was not eroded for the promoters, and now they're losing that. And that's a pretty mindset, and I think what Uday you said correctly, that is setting in. And I think we hear a lot about in the newspapers that promoters are moving to the banks and trying to get a settlement on. People who have absconded out of the country are trying to come back because they want to save their assets. So it's a positive thing.
And, just sort of linking this back to your original question as RPs, when this journey started, and as per the code, we are required to step into the company, take over the bank accounts, issue public notices, etc. And the kind of issues and challenges in certain cases that my teams have had to face, that indicated that, the people who didn't understand the implications of it. They're saying, listen, don't come at 10 o'clock, come at 4 o'clock, we are busy. I said, hey, listen, we're supposed to change signatories in your bank account. It doesn't matter when you're free. We are legally bound. That's a court order. Please understand. So I think it has taken time to seep in that really the moment the order of the court has been passed, admitting your company in insolvency, your company is in play. Yeah, and I think that has taken time to seep in.
I agree. I think I was part of the team when we went into Bhushan Steel, and I remember changing the bank account was a nightmare. Talking to the CFO and the key officers so that they can at least give you a respect was unheard of. Because they said, there's some sidey has been appointed, he's going to just sit there. And I think from where we started and where we ended, it's a pretty interesting change.
Yes.
I'll just add a couple of things. I think glass half full, glass empty, or half empty. I think the glass is definitely far more than half full. Relative versus absolute, right? Have things changed? I think it's a quiet revolution. As Uday mentioned, could you conceive of a company the size of Bhushan Steel changing hands in India? I look back to the mid-90s, quite far back. There was similar talk of reform. I used to be at GE Capital. The timeline we used to ascribe to a recovery, if things went wrong, used to be 10 to 15 years. Now we're talking of a compressed 6-month process. From the relative improvement, if we focus for a moment on potential for change and improvement versus where we're at, of course it's early stages in that innings. So as we think of how good resolutions could be, how good turnarounds could be, I think the ecosystem is taking shape. The last few glitches, legal hurdles, finessing will start to take place. But I think a new era is here where, without doubt, there's cause for optimism. Expertise and capital need to come in. And now I think the next phase is trying to figure how focused expertise gets applied situation by situation in each of these.
Coming back to you, Parth, I think a lot of time I hear rumblings in the banking circle with banks, and Saleh is sitting next to you, so I think you should answer him. That a lot of people believe that people like you, who were early starters, got a steal in Monet Ispat. And I thought that maybe you both are sitting there and people are all confused about steel and all these things. What is a fair valuation? And what should it be? Should it be looked at 28% of the outstanding debt? What is our outstanding debt really is? So I think maybe this is something which you should talk to. And I think the entire audience should understand that really that haircut thing which we are hearing about it, what is really behind the story?
So let me kind of go back to sort of basics, right? Let's look at how loans are. You have a principal, then you have some amount of capitalized interest, and then you have accrued interest. And obviously all going well, banks get paid all of that back, it's amortized out and done. But in an insolvency, in a non-performing asset, a non-performing loan, what ends up happening is you've got a certain point in time when the company cannot meet its obligations and stops And at that point in time, you've got three components, really. Accumulated interest, capitalized interest, and principal. Now, what do you buy it at, right? In the end, the principal is all that has really gone into the ground, right? If you take an asset, you build whatever you're building, a steel plant, a cement plant, whatever you're building, let's assume you built it for 100 rupees, right? Over and above that, if there is capitalized interest of 100 rupees, and then you've got accumulated of, let's call it 300, the value now sitting is 500. But the asset I'm buying is worth 100. Now and then there's degradation of the asset, given the fact that it's not been performing for a while. So do you then buy this at 50 cents, 50 rupees? Do you buy it at 25 rupees, or do you buy it at 75? Let's say you buy it at 50. In the buyer's eyes, you've got an asset that I've bought at 50 cents on the dollar. Why? I bought 50 rupees, 100 rupees worth of asset, bought at 50. The bank might be thinking about saying it's actually only 10 cents on the dollar, because they've got 500 sitting on their books. So that's the question. The question is in the eyes of the beholder. What are you buying? What's the asset? And what's the value? And then finally, I'll always say this, right? It's not about what you buy it at. It's what the actual value of the asset in your eyes is. What can you do with it? Which is why we found in the larger assets, the dirty 12, if you will, most of the bidders have been strategics. If you go to the next level of companies, which is companies, I'd say in the 2,000, 2,500 crores of face value, the 500 that I talked about, 2,500 crores of value sitting on the bank's books, there will be more and more financial bidders. And when you go down to the next level below that, you're going to see a lot of ARCs, financial guys participating, because, again, there's value that can be created. With the large ones, strategics get in. They can always do a little bit more than what a financial can look at. But, financials will look at pure returns. A strategic will look at a 20-year return. A financial guy will look at a 5, 7, 8, 10-year return.
Very interesting. So basically, in the books of the bank, you have really the loan, the interest, the capitalized interest. So when you look at the haircut, it's all that amount. But I think very interestingly, Mr. Saleh, if you remember, Raghuram Rajan at one stage said that, and I think good that we started with Raghuram Rajan, that he said the problem of Indian NPA is actually over-financing. And that's the reason the haircut sometimes needs to be looked in that background as well, as what just now we heard from Parth.
Yes, Parth did mention about, the P plus I, the principal plus accrued interest. When the bankers look at it, they also look at the accrued interest. The reason being, we are an intermediator. We take deposits, and that is lent out. When we take deposits, it doesn't come at a zero cost. There is an interest to be paid. So that interest, we need to get it out of the borrower. So when we look at from a balance sheet perspective, and the fact that we need to pay out this interest to the depositors, we have to look at the interest that we can recover from the borrower as well. But then we are all, practical, pragmatists, etc. We know that is very difficult in a situation that Parth was just mentioning. The security on the ground does not take into account the interest component. And often in a project loan kind of situation, and part of the interest component is capitalized. The principal actually covers the capitalized interest also. So you have the security, the actual assets on the ground does not reflect the principal. So to that extent, we are pragmats in the sense that we know that, yes, the accrued interest, while we want it, as far as possible, we'll try and recover it for us. We know that it is not there, and we also know that part of the the principal also does not have assets on the ground, and therefore we may have to take a haircut. We are aware of it, and that's how the resolutions are happening. Every resolution that has happened, if you look at it, there's been a significant haircut that's there. Now, to take off the original point about the half glass being, half full or half empty, IBC has really changed the game for us. Originally, we used to have, one of the ex-finance ministers used to have this interesting comment which says that, the promoter used to come in a Maruti car to take loan from you, and then he comes in a Mercedes-Benz to say he has no money to pay. What IBC has changed is it has changed the balance in favor of the lenders. In fact, when the IBC started off, even then the promoters were diffident about, coming on the table, etc. But after the 29A, you suddenly saw a sea change in the attitude of the promoters. They are now, coming to us and discussing and looking at ways and means of resolving the issue. So that's a big change that IBC has brought. And the other, of course, is again on the half full. If you look at, the last 15, 18 months of the journey of IBC, and particularly last year versus this year, from a practitioner's perspective, last year we saw a lot of action on the IBC, a lot of action. You have the data doesn't going into the IBC, you have subsequently under 26 being referred, then RBI came out with the 12th February circular, which, laid the path of an automatic, unless resolved, an automatic, push into the IBC. A lot of action happened last year. What did not happen last year was the cash at the end of the table. If I look at, the resolution happening within my own bank and how it spanned out, we had, about 60% plus coming out of compromises. Practically nothing out of NCLT. And substantially about 15 to 20% coming out of the ARCs and partly by SURFACE. And the DRT, mind you, just contributed 2%. Come this year, if I look at the experience of the last 3-4 months, it's a sea change. It's a sea change in the sense I expect nearly 80% to come out of the NCLT. So it is more than half full. For bankers, from a practitioner's banker's perspective, it is more than half full.
So just to give you, Mr. Saleh, and to share with the audience, that the World Bank had done studies on recoveries in India. And they said, I think if my memory is correct, the story said that it takes 4 to 5 years to recover, and then you recover 23 cents to a dollar. That was the number which was there. So really, if what the numbers you are talking about is quite significant. It's almost getting there, right? It's not half full, much more than half full, maybe 3/4. But tell me one thing. If the government did not have the political will to squeeze out promoters, existing defaulting promoters, you mentioned about that 29A, do you see the glass would have been virtually empty?
Squeezing out the promoters. Why do you say that?
That means they do not have a right to bid for the assets.
See, let's face it. The promoters bring the best value under the IBC. If they are permitted to bid, they bring the best value. But then, you're going to have an indisciplined system. Now, what the 29A particularly has done has bringing that discipline. Perhaps the value may be a little lower when they are kept out of the IBC process. But look at the discipline effect it is going to have on the ecosystem. You should be looking at IBC from the perspective of the existing stress assets. You should also look at it from the long-term impact it is going to have on the system. The fact that, you get into the IBC, the promoters are going to lose control of the companies is a sobering effect itself on the promoters. So he will work the system to ensure that he ultimately doesn't go into the IBC. And that's going to benefit the bankers.
I agree. Going forward, I think we all definitely understand that the Mercedes-Benz will probably, or Jaguar will probably not be there. And probably he'll sell off the Jaguar to save the company before he probably come in the Maruti, hopefully. But I would say that the entire thought process, if 29A was not put in the place, then virtually it would have happened that through an IBC process, the promoter would have bought back the company, which, as per Raghuram Rajan, is largely not the issue of losing competitiveness, not the issue that the business became they lost the business because they got out of the business because it was outdated. But it was issues of overfinancing. There were a lot of other issues. So if that is the issue, so if they're losing money and losing company and then they are participating in bids and they are going to go and pay for the banks and clean up the books, I think it's a positive thing. And I would say probably this impact will go forward and go a long way to make sure that going forward there are no problems.
Absolutely, yes.
Look, I think, Mohit, you're right. I'll say this, right? The information asymmetry that exists, the promoter's always on the right side of it. They've been inside the company. So if you had a process where a promoter could also bid, it'll be a little bit of an inefficient process, right? And the inefficiency would lead to possibly, I would imagine, lesser bidders come into the play, and hence one doesn't know the effectiveness of the actual code. So I think 29A is good.
I totally agree. If the project which we work together, if the existing employees knew that the existing promoter could get back in the driver's seat, probably we would have never made an entry to any of those plants ever. And I think that goes back to the basic issue that, yes, it looks difficult. It's probably not global standards, but overfinancing is also not global standards. I think the lack of that rights is also not global standards. So I think some draconian thing had to be done, and government fortunately had the political will, which in a country like ours is not easy.
Except that 29A went beyond just the promoter of the relevant company to exclude a whole bunch, and it's been expanded even further now, such that it almost seems as if no Indian promoter group could ever bid for an asset. You are judged by the company you keep, and it just seems very strange. That the idiom is coming true that just because you got, let's say, married into some family. I think 29A, while, may have been well-intentioned if it was restricted only to the relevant promoter of the corporate debtor, its expansion in a manner that, anyone who is unrelated to that group also, but because he has had some stress somewhere or some issue somewhere, he gets debarred. I think that is potentially also, in my view, even hurting maybe competitiveness in some way and value realization.
I'll just add quickly. I think, without doubt, there were some inefficiencies that have been negatives in the short term. On the other hand, if all you did was ban the promoter of a particular company, they'd have arrangements. One guy would bid for the other guy's company, and this guy would bid for that company, and in practice, things would just carry on as normal. I think in the circumstances, promoters miscalculated, and in the early days were very brazen. They misinterpreted the intent and actually made sure in the early 4 or 5 months of the IVC, or the first few cases, that basically no information was going out. Their assumption was it's coming back to us at a deep discount. So there was an assumption that this is kind of BIFR Part 2, and thankfully there was an intervention at the right time. You needed something completely dramatic rather than allow one innocent to come in. You sort of made sure that not a single errant person was able to re-enter. That's the reason, as Mr. Salhi said, that in every situation where there's NCLT risk now, the promoters are in a fairly reasonable negotiation. They still haven't lost count of the fact that interest matters. So they complain to people like us about the fact that they had to pay interest for 3 or 4 years while they commissioned a project, and kind of believe the banker isn't owed that money. There is a little bit of an assumption that the company is basically theirs, and the old world formula that the haircut of the debt is just a haircut to the debt, and the notion that it then transfers value to equity is missing in their interpretation. But bar those 1 or 2 things that are also getting smoothed out, I think by and large there was no better alternative left than to come in hard and basically just keep promoters out. It's really starting to fix the system. So the long-term benefits are going to be huge.
Completely agree. I think Anurag is right. I think the issue that would have come through if you allowed promoters, even if you said you've got to solve it, and will there be some change tweaking of this, it'll come. I think you're right. But at this point, it had to be a draconian thought process, and then you'd have to ease off from there.
I'd even go so far as to say once promoter behavior falls in line with the underlying nature of a credit contract, whether it takes a year or 2 or 3, once we get to a point where banks can profitably lend. In the past system, it was impossible for a bank to profitably lend into this economy. You can't lend at 20%. It doesn't work. The return on assets isn't there to fund that. So banks were basically set up in such a way that if they continued that lending practice, you'd never be able to be profitable. You needed continuing capital injections. I'd go so far as to say in the long run, perhaps at some point, promoters should be permitted to bid. But that day is a few years away.
No, I think very fair point. I think particularly, if you look at probably guys like us, and maybe more not like us, like we are corporate lawyers, we do M&A and private equity work, but more by litigating lawyers, if you see, that whole structure is based, as what Bikash just said, on poor drafting of law. So you pick up an issue and you draft it so poorly that everything under the sun gets captured. So you have a law which came in 2016 end, you had 3 amendments, and hundreds of times you go to NCLT and NCLAT or High Court, because unfortunately, I think laws are drafted by bureaucrats and keeping that bird's eye view, and then they miss details, and then they allow Parth to bid through because he's a private equity, not a strategic. So I would say that thing keeps changing, but at least what is good, no, because earlier they banned that if you are part of the
You did not want us to be bidding as private equity guys?
Pardon?
Is that what you're saying?
No. Earlier, in the earlier regime, if you had participated in one of the companies which went to insolvency, then you would have been disqualified. But they said, no, private equity is not really a strategic, so we have to allow that. So what I'm trying to say is that they keep doing that, but at least fortunately, what we are seeing is that in 12 months, we've had 3 amendments. And NCLT and NCLAT is clearing it up so that at least we are seeing resolution. Yes, laws are badly drafted, and yes, it brings draconian consequences, but maybe that's what is required. Uday?
Yeah, so, I mean, maybe the pendulum has swung to the other extreme right now, as Bikash described. But I think in India, it will not be politically expedient for a promoter to be, stepping back into the company with a huge discount to the haircut to the lenders. So I think we are a little far away from that day. So yes, there will be tweaks in this journey. We have a couple of cases before NCLAT matters will go to Supreme Court. So maybe the law will be settled. So we may moderate, this extreme a bit, but I don't think it's going to go back to, just allowing the promoter to bid. He takes, the banks, the lenders, everyone just takes a haircut and he comes back into the company. As it is, people are extremely wary about, who's this bidder, who's he really backing. We are seeing it even in live cases today. Yeah. Who is he really representing? Where is he getting his funding from? So those are questions that bankers are, asking, and rightly so, maybe.
So Anurag, I come to you about this new thought process which the Ministry of Finance have talked about, Shashakt, and they're talking about AIF, institutional funding, AMC. I saw yesterday Uday Kotak saying that they are setting up a AMC for this type of institutional thing. And I think he quoted that this is probably a once-in-a-lifetime opportunity. I remember seeing that this type of a stressed business and money to be made out of stressed business is once-in-a-lifetime opportunity. I see Harish Chandra laughing, but I can understand that. But Anurag, what is this new project which we are talking about, 180 days? Will it work?
I think it'll work in part. My kind of considered view here is, as you look at the current clearing of projects, one, everyone's very focused on the successful large ones. The system's learned a lot from them, but there is a large crop of slightly smaller projects that need to be turned around, resolved one way or the other. I think a couple of the inefficiencies in the current process start to be tackled. One is on the side of the seller. When you have a consortium of banks, getting 10 banks, 12 banks, 15 banks on the same page at the same time doesn't really work outside of IBC. and more or less doesn't work even within IBC. It's the forced timeline.
But did you check this news that 23 banks have signed intercreditor agreement and appointed the lead banker to be acting as a resolution professional virtually to resolve the issue in next 180 days?
And so that's the first fix, right? What you've done basically is said, let's sign an intercreditor agreement that kind of supersedes that and makes sure that the inefficiency in getting everyone on the same page is sorted out either in some phase pre-NCLT or perhaps on a continuing basis after. Then it comes to the other side, which is the other deficiency to some degree, price discovery. That just requires a wider number of bidders. Even in the large cases, it's been narrow bidding. You see lots of expressions of interest. People who know the asset come in many cases, many back off. But most importantly, in a very large number of cases, there are almost no bidders or one bidder. And here what should start to happen is there is a centralized clearing of information. There is a predictability of the decision frame. And so there's an ample opportunity to come and resolve in some form. One of the things that I think would be very helpful is to make sure that the buyer in this case is, people like us putting up half the money, the government transferring some of their 18,000 crores into a fund that combines 50-50. So now if the government's putting 18,000 crores directly into the banks, imagine that people like us put up 18,000 crores, you take the government's 18,000 crores, now you have the advantage that the trickiness in price discovery has limited downside. So if we come in, as long as people with some capability, some expertise come make an honest effort to turn it around, if there's a nice outcome, half the effort or benefit transfers back to the government, to the public coffers. If it fails, it fails. And then the people from the outside that made the effort actually have real dollars and lose money. So
one of the key thought process behind this new proposal was that this will create market, particularly not these dirty 12 dirty dozen projects, but all the power projects and others where there are less takers. And if you put all these things through the process, you will not get right bidding. And this is basically like a guy who says, if you don't hit above the reserve price, I'll take it away.
So
is that the view?
It is. If you look at IBC's intent, there were two pieces, right? Creditor-led, market-driven. Now, it has been somewhat creditor-led, but you could argue that relative to creditor, as COCs have tried to find their feet, the process has been to some degree even RP-led or RP-constrained, right? Very, very, very tedious processes. We don't have the time left to dedicate to actually trying to understand the business. There have been cases where you get 7 or 10 days to bid. That's the first time you see an IM. That probably has a tenth of the information you would need to make an informed bid. So creditor-led is transitioning. There are situations now where we come in, the RPs have found their feet. We're finding our feet as investors saying, if we're on the committee, here's how we'd like to make sure this happens. Flip to the other side, market-driven, almost absent, right? Other than a Bhushan, other than a Binani, by and large, the market-based determination of price has been very limited. Again, information's at the core, time and effort are at the core. This will help because you have a nodal agency that will act as a clearinghouse. 2-3 different parties could bid. You only need 2-3-4 serious parties to discover price reasonably, if there's basic competition.
But I think, Mohit, if I look at the power sector particularly, I think the challenges are several. And if you follow this process through to a logical conclusion, 6 months, you don't get a resolution, you put it into insolvency. So yes, I would tend to agree with the statement, it's the opportunity of a lifetime.
Opportunity of lifetime.
Lifetime, right? But the question is, a certain sector like a power sector, it's going to get completely morphed, because today you have assets at various stage of construction, various stage of, operations. There is debt. There are cases already which are being put in the bidding process. There are cases referred to NCLT. Lots of people are picking up expressions of interest, doing window shopping. But finally, there's hardly any bids coming in, where there are sale processes being run. Because probably the feeling is, if this asset goes into IBC, if I'm paying 50 cents on the dollar, I may be able to get it for 20 cents, right? So, yes, from a banker's perspective, from a stressed asset investor perspective, it makes sense. What's sort of bothering the government and the bureaucracy is, are we doing true justice to the power sector? And if we were to work on revival of this asset, normal banking channels, and say there was a 3-year period rather than an artificial 180-day period, would that asset be at a far superior valuation than the 3 crore per megawatt that is generally
Mr.
the
Saleh,
rule of
I
thumb.
think I was...
So maybe I would really like to see the bankers' view on this. Yeah.
See, power sector is there, of course. If you take it a little larger, I'm coming back to the ICA. When we look at, this flow of, stress assets to the IBC, the kind of valuations that we get under the IBC, keep aside the dirty dozen and the big, the newsmakers, the value that we get under the IBC is not really what we are happy about. And we would like to see a lot of these action happening outside the IBC. The challenge we have for the bankers is most of these assets are on a consortium or a multiple banking kind of scenario. And let me tell you, if you look at the 12th February circular, RBI has given a very clear 180 days. Resolve or IBC. To get, this kind of resolution within the 180 days is a big challenge for us. It is not getting into negotiating a reasonably good and acceptable deal that's time consuming. It is consensus building. And in fact, I was in one of these, major, trying to resolve a particular deal. There were about 15 bankers. And the most vociferous voice against the deal was from a 2%, share bank or a 3% share bank. And if you look at the RBI circular, unless 100% is on board, a deal is not possible.
But if you under the IBC, the thresholds have come down from 75 to 66.
No, that's why I said, before getting into the IBC kind of environment, where of course it is very clear. In fact, you are right, it has been brought down from 75 to 66%. But like I said, the smaller accounts, except for the big, is when you come down to the smaller account, the value that we get out of the IBC is not really what we feel that perhaps we can get better value outside. If you negotiate a reasonably good deal with an investor or a change in, various ways, perhaps we can get a better value. And that is where the consensus building between the banks to arrive at an acceptable deal has eluded us. In many cases we have seen, and that's where the ICA comes. ICA possibly will give us a platform to generate that kind of a deal going forward. Perhaps we may have missed the 27th August deadline or the 2,000 crores plus accounts. But going forward, that will give us a ready platform for that consensus building.
I agree. I think 180 days was there in the RBI guideline. Whatever people can criticize, I think they are coming up with a framework. Intercreditor is getting signed. I saw one statement by SBI that they will look at 3 crore a megawatt type of a number, irrespective of actual money on the books or the debt on the books. So these are very positive things. I would say that probably we have to have multiple opportunities and options so that these companies get resolved. But I think, Bikash, we are all talking about business, and you are the boring lawyer, and this doesn't work, that doesn't work, the COC is not authorized to do that. We have to go to the NCLT, NCLAT, High Court. Tell us, if you look at legally, if you look at it, is the way the whole provisions have come in, the lenders, I would say, they're going after promoters on guarantees. A lot of these things have happened. So if you give us some few minutes of bird eye view about this act. How does it work as a lawyer? And how will you feel that what are the key things which are missing or which needs to be fixed so that resolution becomes speedier, faster?
Okay, so, the act's been in operation for 18 months, and, it's been generally, the feeling has been, as everyone mentioned, that, it's more than half full. It's a great attempt to, ensure resolution of stress. The amendments also have been, one could imagine, it's very difficult to say that about governments that, they typically react. They are typically react after the situation has happened, but here, to quite an extent, they are even when one situation has happened, they have reacted very proactively to tackle potential challenges, 29A being one of them, as to how to kind of take away promoters, how to ensure that maybe people get comfort around the fact that they can non-promoters get comfort that they can bid and have a real chance at realizing value. I think the key challenge which I see from IBC when it has been implemented is this concept of value maximization. The courts as well as COC and, every stakeholder involved has been burdened by this concept of value maximization without there being a understanding of really what is it that should be achieved. Okay, the courts have been, the NCLTs have been forcing I believe that, value maximization is the paramount objective of the code. Whereas at the same time now there is an independent signal from the government and regulations from IBBI which seem to suggest process is very paramount. That, it is the process which needs to derive the value. Okay, and whatever then the value comes from there, okay? Which means, so then what happens, a late entrant would not be able to, let's say a late credible offerer, isn't he then entitled to offer a significantly better deal, right? I mean, why should that be stopped? So what, the objective is to run a process as per the IBC, or is the objective of IBC to, make sure lenders take a minimal haircut while all the others also, their interests get balanced. So, I think this is one aspect of the IBC which is not coming out, clearly in terms of thought processes of various stakeholders involved as to what is it that the IBC should achieve, what is it that the COC should kind of look towards achieving, okay? And then there are, of course, challenges and interpretations around liability of the RP. Then, recently there has been a kind of a confusing, at least when we read it, it seems like, that, we're not sure what the intent of the NCLAT was. It seems to suggest that, guarantees can continue post a resolution plan being approved. Corporate guarantees given by the corporate debtor. Now that kind of appends the entire insolvency structure, that liabilities on the balance sheet kind of get cleaned out or are capable of being cleaned out as a part of the resolution plan. If guarantees can continue, does that mean operational claims could also continue? If, let's say, for a moment, the operational claims have not been filed, and not everyone files it. And if it is that, operational claims which have not been filed can continue, then what is the incentive for anyone to file those operational claims? Okay, so there are these issues which seem to be coming in. I think there is some attempt of some continued education required of various stakeholders. But broadly, the IBC process has been great from a lawyer's perspective. I mean, you get to kind of develop a new practice area, and jurisprudence around it, and mostly the NCLTs, NCLATs, and IBBI have been very supportive. There are these few areas where the what should one be doing in circumstances is not coming out very clearly. But yeah.
Basically, when I look at these issues, I look at very differently. That really, NPA is a commercial problem. It's not a legal problem, right? You have taken money for building a house, and you can't pay because you lost a job, then you have to sell the house and pay the bank. It's a commercial problem. It's not a legal problem. Why did we come up with a process? It's a highly prescriptive law, IBC. Because bankers and everybody was worried about taking the haircut. So they said, okay, let's do a very prescriptive policy so that we say A, B, C, and this is 10 days, 21 days, this has to be done, all those things.
Except
but really,
one point. Originally, it wasn't a prescriptive process. Originally, it was one of those processes where banks had the freedom to paint their own, way through the process. It is now that, processes are being given more
I'll come to it. Basically, what I'm saying is, it's all relative. In my view, IBC was always very prescriptive. Now it's more prescriptive. So what I'm saying is, it is a commercial problem. And really, if banks are not getting paid, they need to get the maximum amount, right? That's a common sense. And therefore, price maximization has to be obviously on the card. I don't think, and the way, as I believe, is that the aim is to get maximum valuation. That means minimum haircut. And process is to get to that aim. And if the process needs clarification, because we have tried to solve a commercial problem through a process, and the process sometimes requires a lot of discussion, so you go to NCLT and NCLAT and get the process clarified, because no banks is wanting, or no COC wants to take that call on themselves. So I would say, really, it's a fair process, it's a commercial process. COC should take a call, and if they feel that they can't take the call, then they should go to the NCLT, and which adds to the delay. But to say that the process is bigger than the process, the purpose was which the act came into place, I think it's a ridiculous idea, in my view. It's a ridiculous idea, though lawyers believe in processes, though we don't follow a lot of time processes ourselves, but we believe in processes and we sell processes. But I would ask Parth to react on that, and then I will ask Uday to react on that because I thought that I said something which a lot of people will not agree. But I would say maximization of value should be there. Process should go towards that. If what Bikash said, that some of the things have to be changed, so be it. But to tell somebody that, hey, you operational creditor, you will get a haircut because the bidder came 10 minutes late. It's a ridiculous idea.
Look, I'll just say this. I think law firms probably have put more billable hours on NCLT and IBC than anything this year. So law firms are happy and should be happy. But your point is right. I think your point is about the process is the means to an end. And the end, I'm going to take off my private equity hat and I'm going to just look at a very simple problem, as you said rightly. You're building a house. You've taken a loan. The contract says that loan is due. And if you cannot pay, the bank or the creditor should be able to take that asset and get as much value as they can out of it, right? There should be no discussion about principal, accumulated interest. You've not paid. Hence, beyond that, that belongs to the bank. Accumulated interest is interest. For whatever it's worth, Mr. Sali was right. I'm a depositor in banks. Of course, that is important too. That's the right thing to do. So I think the big thing we should talk about is time. In terms of what ends up happening is when a company, let's say it's an operational company, becomes an NPA, it starts getting into operational degradation. And the more the time between changeover of the existing management into a new set of owners who are going to run it with a balance sheet that is efficient and is usable and workable, that is the period one needs to minimize. Because what you've got going on is, let's say it's a steel plant, let's say it's a car manufacturing, whatever you want to call it. You've got a few things happening. You're not meeting your clients, customers. Hence, the customers are going somewhere else. So you're going to lose value. Machines are not functioning. You're going to start degradation, and you've got loss of jobs. So I think the right thing to do is process should be efficient. It should get us to the end. For the banks as well, remember, every month that this process drags on, theoretically and practically, there is loss of value. So that's what it is. The process has to get means to an end. And that's what it is.
So I think very interesting summary that yes, price maximization is important, and process is to get to price maximization. But as what you just said, Parth, that this process cannot go for way too long, because that's a flip side of discovery of price. And I think you cannot keep discovering the price and have a closer deal, because that's an important part. I think, Uday, you want to say something?
So I think what I would say is that our role is that of an administrator, or RP as it's called in India, and our job is to take over the company, run it to preserve value, and there are a whole bunch of responsibilities associated with us, and to facilitate the process for ultimately the lenders who have to take a call on what's the most acceptable resolution plan. Now, the matters have got complicated because you've got, lenders who are predominantly government-owned banks who need to follow a certain set of transparency, their own internal protocols on how they take decisions. Also, the legislation which predicates a certain waterfall and, who gets what and, in the entire process. So that's where matters have got complicated. I am pretty positive that in the next 2-3 months, we have cases on the boil where we have certain judgments which hopefully come out, which will help resolve some of these issues about, value maximization versus process, acceptance of late bids, treatment of certain classes of creditors to the advantage, disadvantage of others. So some of these niggles will be resolved. So yes, our job is to follow the process and administer it. I don't think we have a value judgment in, what should be done and what's the right way to go about doing it. And that will be dictated by the environment.
Thank you very much. It was a very great thing, and thank you very much for my panelists.